afternoon, everyone. Good morning. My name is Greg Mencken. I'm the Executive Director of the Adam Smith Society. I'd like to welcome everyone for joining us today for our virtual programming series. Before we begin, as always, I want to wish all of you health and well-being during these very difficult times. While we have canceled or postponed most of our events, as we all know, we are not postponing our important mission to promote discussion and debate around the benefits of free enterprise. So while many of us work from home and learn from home, please join us every week for a Smith Sock break for a lively discussion around a variety of topics, including the broad implications of coronavirus. If you're not already a member of the Adam Smith Society and would like to learn more, please visit us at adamsmithsociety.com. Joining us today is economist Allison Schrager, Senior Fellow at the Manhattan Institute, to discuss the economics of risk and how companies respond to shocks. Allison received her undergraduate degree from the University of Edinburgh, making her a natural fit for the Adam Smith Society, of course, and she received her PhD in economics from Columbia University. And if you're looking for some good reading while we're all here at home, check out her book, An Economist Walks into a Brothel. She's also co-founder of a risk advisory firm, and her writing has appeared in The Economist, Reuters, Bloomberg, Wired, and many, many more. You can follow Allison on Twitter at Allison Schrager. Allison will give a 15 to 20-minute briefing followed by audience Q&A. Please note this conference is being recorded. You may ask questions in the question box in your GoToWebinar controls. Questions will be read aloud to the group by my colleague, Dean Ball. Please keep your questions and comments brief and state your name and chapter affiliation to ask a question. We'll try to get to as many as possible. You do not have to wait until the end of Allison's opening remarks to ask a question. You may submit a question at any time. And with that, Allison, the floor is yours. Thank you.
Great. Thanks so much for having me. So I think it's obvious that we're all living in incredibly risky times, and companies and individuals are having to deal with shocks that they never imagined happening, or even taking, doing risk management. It feels like incredibly perilous. Like even deciding whether or not you're going to take a walk tomorrow feels fraught with risk. So I thought I'd use this time to both discuss, sort of harder risks and unknown risks that are harder to manage. But also, I think it's important in these times to not lose track of the fundamentals of risk management, the tried and true things that work when you do have decent data, when you can weigh risks, because as the weeks progress, we're going to get more and more data. I mean, right now, everyone's sort of bunkering down and we're in an extreme period of uncertainty. But as the weeks go on, we're going to get more data, and it will be a really important time for risk management, both as individuals and as companies. So to just kick things off, let's even discuss what risk versus uncertainty are. So the future is always unknowable. I mean, I think we're certainly all living a reality none of us could have imagined even a month or 2 months ago. But sometimes you know more about the future than others. So you can see in this picture here, this is how I think of risk, which is sort of a probability distribution. These are all the things you can imagine happening and how probable they are. And, this is a normal distribution. Maybe it is fat or tails. Maybe, it's skewed one way or the other. But, depending on the risk, this is generally roughly what we face. And as you can see, you've done a lot of statistics and probability. In this middle part where it's, fatter, these are the risks we think about every day. These are typical business risks, shocks to revenue, differences in demand, even sort of maybe even a standard recession is in there. And what you have in the tails are these like huge outcomes, things that are much more potentially catastrophic, or even sometimes potentially like a huge windfall, but they're a lot less probable. And risk, as I said, is all of these things. And you plan around how probable they are. Now, most of the time, we plan around risks that are more likely, like in that center part of the distribution. But we also try to be thoughtful of what goes on in the tails and how to manage that too. And that's always, I think, sort of one of the sort of bigger tensions with risk management is how much do you worry about tails versus how much do you deal with sort of more typical risks. Now, uncertainty is really, I think, more what we're facing now, which is, I guess, what we call an off-distribution risk, like a situation you never even sort of have on this distribution because it's something you can't even measure, it's something you can never even imagine, and it's certainly something you can't prepare for. And I think that definitely puts all of us as individuals and definitely a lot of companies in a really bad spot. And it's really hard, as I said, to do good risk management now. I think that's why we're seeing financial markets move all over the place, is because what we're dealing with is unprecedented. The way we come up with these nice little risk distributions where we can do nice risk management, in a little while I'll discuss what risk management means and how you can make this distribution look a little different, is, we create this distribution with data from what happened in the past. This is usually based, as I said, like when we look at stock market returns on years and years of what's happened in the stock market. The problem with what we have right now is we don't have any data to make distributions like this. I mean, what we're dealing with is completely unprecedented. I mean, people like to compare it to the Asian flu in 1957 or the Spanish flu in 1918, but I don't even think that really tells us that much because, our healthcare systems were so different. The pace of globalization is so different. Even that sort of is really giving us very sort of sketchy implications of this. And I have to admit, the risk economist in me, who spent my whole career obsessing about risk models and probability distributions and exponential functions, is taking a very small bit of pleasure that now everyone is obsessing about these things. That even in Andrew Cuomo's briefing today, he spent a lot of time describing how these curves move as you get more and more data. And as I said, they're going to get tighter. They're going to get a lot more certainty as the weeks go on. And I think that is, as bad as things are now, something to look forward to, because data will become more meaningful. And then we can move more to risk management as opposed to right now just hunkering down and feeling like we're in a place of chaos where we have no control. So looking forward to that happy time, I'm just going to go through quickly sort of how typical risk management works. And then, as I said, we'll talk a little bit more about how to deal with uncertainty like we are now. So the first step in risk management, which I think people don't really understand or lose sight of often, and this is true, as I said, all the time in business, certainly in finance, certainly as individuals, is we're not really clear what risk we're really concerned about. And often the way we define it is, well, what is risk? The opposite of it is risk-free. And what risk-free means to you often defines what risk is. So I'm just going to take an example from retirement finance. So can you show the next slide, please? Okay. So when we think of investing, and we're certainly seeing this right now, we think of a risk-free asset as like a short-term treasury bill. This is a 3-month T-bill. And you can see over the years, you can even see a little movement around 2008. You can see a little uptick just in the last month. But you can see the return on this asset is pretty stable. So we tend to think of this as a risk-free asset because if you have money, the odds are you invest in this, you're not going to lose it. Well, I mean, inflation's a different story, but just assume inflation's predictable for now. So this looks like risk-free. And in fact, if you look in the retirement space, when you look at a very popular retirement investment strategy, we think of a target date fund, which moves people more and more into T-bills as they age, thinking this is taking more and more risk off the table. But when it comes to retirement, you're not really thinking so much about having this one pile of money one day. You're actually thinking about a longer stream of liability, which is consuming and eating and having income throughout your retirement. Or as I said, if you are running a company, are you really thinking about making sure that you have a stock of capital, or are you thinking about longer term liabilities you have to pay? So if you want to show the next slide. Okay, so this is that same 3-month T-bill, and this is also the price of a 20-year nominal annuity. Now you can see that that T-bill really doesn't do anything in terms of annuity prices. So this is just the price of a stream of income far into the future, or 20 years into the future. So regular payments for 20 years. And you can see that these things just aren't good hedges for each other. I mean, just look at, for a while, 2008 was my big wow moment with this slide, but just even look what happened at the very end, what the price is of 20 years worth of income and how much it went up. I mean, you can see a little blip on the T-bill, but it is not really nearly enough. So when I was watching CNBC recently, they were giving financial advice, and they said, oh, Jess, if you're saving for retirement, make sure you're staying away from long-term bonds. But as you can see, if you're actually planning for income in the future, being in short-term bonds is not a great idea. Could you show the next slide, please? Yeah, so you can barely see it. You can see those little light blue. But this is, I'm also layered in a 10-year bond, which has a similar duration to a 20-year annuity. And you can see it tracks that 20-year annuity pretty well. So what you're actually doing is hedging that risk. So what is risk-free? We always think of risk-free as being a 3-month T-bill. But if you're actually a soon-to-be retiree who's planning on spending your income one day, actually a 10-year bond is actually a much better hedge for for managing the risk of retirement income. Look, it even went way up. Now, if you were just concerned about sort of keeping a certain asset balance, you can see it's been very volatile. But on the other hand, if your big concern is income, it's a very different story. So I think this just shows where we go wrong often with risk management is we've misspecified risk-free. You can see you can be exposed to all this risk unknowingly if you haven't thought through what risk-free means to you. And you can also see the other thing is how expensive this has all gotten. As interest rates are going down, interest rates on the longer end of the curve are definitely been all over the place. You can also see that it's gotten incredibly expensive, which is forcing people to take a lot more risk. We definitely, this is a concern now going forward in the future of how much risk different companies have on their balance sheets, because this low rate environment has definitely encouraged some people to take on more risk, take on more leverage, and that definitely makes you a lot less resilient to certain shocks. So beyond this, once we've figured out what our risks are, what we mean by risk-free, then we can actually manage risk. So can we go back to the first slide, please? So risk management is making this curve look a little different. So what you're trying to do is that downside, that sort of bad thing that can happen, is getting rid of that. And you can do that a number of different ways. The first step is diversifying. So this is just, again, holding a lot of different assets, because that way if one goes up, the others don't. And we can see this everywhere. I think the concept of diversification is becoming a lot more in the news because, supply chain issues. So many companies were very dependent on, say, China for their goods, which really left them exposed to what happened certainly a couple months ago, felt like just happening in one country, meant that they didn't have access to their goods because they were under diversified. Or their intermediate goods to continue with their production. So we're definitely going to see, I think, coming out of this, a lot more concerns with diversification. But it's important to understand that diversification isn't necessarily always risk management, though. And all it does is, again, I heard someone on CNBC, I guess, which is now my big source of contention with saying wrong things about risk, is that you should be in bonds for diversification in this time. And that is actually not technically correct. Diversification doesn't really help you get rid of downside risk. What it does is it helps you not take any more risk than necessary. I like to think of it as getting the most bang for your risk buck. So diversification is like being in an index fund. If a whole stock market crashes, it's not going to do much for you, but it does mean that you're not taking any more risk than necessary on a typical day. So hedging is actually the moving into bonds, or moving into that risk-free asset. And what that does, if you think about this picture, is you give up some of that upper tail in exchange to get rid of that lower tail. So I think, it seems like whenever we have a big stock market event, people have forgotten about that because no one likes to give up their upper tail. But you can hedge by giving some of your lower tail. So the opposite of hedging is obviously leverage, which is, instead of buying bonds, is lending money. And that widens this distribution. And as I said, I think that is the concern now with a lot of companies, that they did take on a lot of leverage going into this. And for that reason, they're now in this much lower tail. The last way you can manage risk is through insurance, which is where technically you pay someone to get rid of that lower tail, and you keep the upside less whatever fee you pay in premiums. And I think certainly I keep reading that a lot of companies thought they would be covered for something like this, even if they hadn't thought about it, because they had this business disruption insurance. But they're finding that pandemics don't apply to this. So unfortunately, I think this is, again, another big policy issue that we have to discuss, is that this is leaving people with this sort of, I guess, insurer of last resort, which is becoming the government, becoming very dependent on government programs because they weren't able to insure from this type of event themselves. Now, I think a lot of people make the mistake with seeing that as some sort of flaw or risk management of companies, and sort of arguing that we need sort of bigger government takeovers because they needed that insurance. Although I would argue that is a fundamental role of government. Is we pay taxes. I like to think of them as almost paying insurance premiums for big, unprecedented events like this. But as I said, that's debatable, and I think we're going to see this a lot more. It just pains me that I already see a lot of people arguing that this is justifying like a wholesale takeover of the government, not even as this virus drags on, but like forever. And I think that's the wrong way to think about it. I'm thinking more of the government as stepping in these sort of very extreme once in a lifetime events to get us back on track so we can end up with markets working the way they should. And so again, this is sort of how you want to think about uncertainty, which is, again, these uninsurable risks you never saw coming. And the only way you can self-insure against them, again, because it's really hard to buy private insurance for these sorts of events, is maintaining flexibility and or liquidity, which is, in my book, I spent time with H.R. McMaster, who was President Trump's second, I think so, national security advisor. And before he was in that role, he actually was a big writer on uncertainty and how to manage that within the military, because you can imagine every time you take on any sort of military expedition, things happen you don't expect. And he always says the key to managing unanticipated risks is flexibility, which in financial markets is cash, because liquidity is ultimately how you can sort of pivot at the last minute and make that flexibility happen. But again, it's very expensive. So in good times, holding a lot of cash, it doesn't really make a lot of sense. And honestly, this is one reason I don't blame a lot of private sector companies who now are struggling, because I think holding the sort of cash on hand to manage, 4 months, 3 months potentially of no business would have never made sense. So I think we want to think more going forward about what is a better way without expecting sort of the huge decline in growth that would be entailed if we expected companies to keep that much cash on hand, and how we can build an economy that's more resilient, because ultimately the only way you can really handle uncertainty is resilience and figuring out what that means. And in some ways, I'm personally a little optimistic that, we're going into this with fairly strong household balance sheets. I mean, not enough for the sort of shock they're dealing with. Banks have fairly resilient balance sheets. That corporations who took on a lot of leverage are a notable exception. But I do think, we are going to this with a fair amount of resilience, so that makes me somewhat optimistic. So I guess we'll move on to questions now, because I've been 20 minutes.
Thank you very much, Allison. We really appreciate that really insightful analysis. So at this time, I'd like to invite everyone to submit your questions if you haven't already. And please do remember to include your name and chapter affiliation in order to ask a question. So Allison, I'll kick things off here, and I don't know, maybe throw you an easy one. So the coronavirus seemed to come out of nowhere. Is there any way a business could have managed this kind of risk, and how will these huge events impact the future of risk planning for businesses?
I think it definitely, once you become aware of tail risk, it weighs on you. I don't know if I'm just naive, but I tend to think humans tend to have very short memories. So I'm not sure long term how much it will change. Although you do see, I think there'll be definitely more awareness. Certainly, next time there's even a rumbling of an outbreak, people will definitely become a lot more risk averse. Although some people did see this coming. I was just reading that Wimbledon had bought pandemic insurance. I imagine those sorts of policies will get a lot more expensive. I'm not even sure the private market could really even support a pandemic insurance market that is large, mainly because, as we're seeing, when insurance companies sell a policy, they count on diversification. That's why it's efficient to insure, is that someone else can diversify altogether and sort of make that risk smaller, which is what diversification can do. The thing is, if everyone had pandemic insurance and everyone claimed it at the same time, all the insurance companies would go out of business. And they know this. So if people are looking for this insurance in the future, it's going to be crazy expensive. And I think that's why our discussions going forward need to be about what is the right role of government in these sorts of situations. I think, as I said, it concerns me that people are we need government involvement all the time, even in good times, versus thinking of what does insurer of last resort look like without sort of incurring any moral hazard or sort of too much reliance on the government, or certainly killing our budget going forward, of how to strike that right balance just so.
We have a question from Neil Chaudhary from our New York City professional chapter. Neil asks, once we're out of this disruption, what are the top 3 or 5 focus areas from a risk management policymaking standpoint?
Say focus areas?
Yeah, 3 to 5 focus areas from a risk management policymaking standpoint.
Okay, I think right now what we're focusing on, and we're going to have to focus on better, is helping businesses stay in business. I think the concern is that there's going to, right now we're suffering what economists are calling it's sort of not completely accurate, a supply shock, where the government had to shut down the whole economy and no one can do their business. But in theory, if we're able to lift things up tomorrow and people felt secure about going back to work and there's no worry about reoccurrence, we'd probably see a huge rebound super fast, because not that many companies have gone out of business. Everyone will be called back to work, and it will be wonderful. And the concern is, as this goes forward, is this is going to turn into a demand shock. Are a lot of people, our business is going to go under while this actually happens, and people are actually going to lose their jobs. And if that's the case for policy, you really need to be concerned about, how do we restart the economy? How can we? I've always been a little skeptical of fiscal stimulus to boost demand, but how can we, do this right? And I worry again that I think we're getting a little off track thinking about things like infrastructure spending when we don't even know the extent of what sort of jobs program we're even going to need, if we're going to need one. I think it's going to be mainly about how can we make sure demand doesn't fall too much? How can we make sure that too many jobs weren't destroyed? And for another is, as I said, that we've got a resilient public health system so people feel confident that these sorts of risks won't arise again.
Another risk, Allison, that it seems the current government response might create is the massive expansion of the role of the state that has taken place just in the last couple of weeks. How do we balance that risk? How do we balance the need for government to step in and deal with these immediate economic problems while ensuring that we're able to keep the role of government circumscribed in the long term?
That is my biggest concern. Again, I don't know if anyone reads the New York Times, but they have a big op-ed project pushing about why this shows the demand, why we need a bigger role for government, and I don't think it does at all. I keep writing on the Manhattan Institute website that the way I really am averse to anyone calling these government programs stimulus, because stimulus is demand management. Whether or not it works is questionable. I think of this as insurance, which is we had a big shock that no one saw coming, that was above and beyond what any reasonable person or company could have insured for, at least not without the extent of lower growth. So it's the goal of policy to act as insurer of last resort and then step away once we've sort of, as I said, minimized any sort of shock to demand. So I said we can have the market take us back to where we want to be rather than having the government. And I think it's a real danger. Again, everyone calling out, and in a way I don't even think makes a lot of sense, that this just shows how the government has failed and how it's uncovering all these weaknesses in our system, especially considering there's a lot of different systems in the world, and it doesn't seem like any country has dealt with this particularly well. I'm not sure why people are thinking these are weaknesses idiosyncratic to America. As I said, to think about this as insurance, not sort of demand management, and have the government. Well, you said I was even watching Jay Powell's talk earlier today, and he was even talking about the scope of the Fed policies, which are effectively to make sure while capital markets are frozen, firms can get loans so they don't lay off people, And then the idea is to scale back these programs as soon as possible. So, as I said, this is about insurance, not trying to manage our way out of a recession.
Allison, I'd like to go back to the curve that you showed us, the risk curve, a little bit, and maybe you can talk a little bit about, the top part, the fat part of the curve, and the edges of the curve, and how should companies manage their risk in that fat part versus the outer edges of that curve, and what would that look like?
Well, I mean, again, this is the big trade-off. Like the way I always describe it to people is like, imagine that you're deciding to go, to go to the airport. Okay, that sounds crazy now, but like imagine like it's several months from now and you're going to the airport, and you give yourself airport time. Probably doesn't take a half hour every time. It probably takes between 25 and 35 minutes, depending on traffic, weather, whatever. So you make your decision based on that 25 to 35-minute window. Obviously, there's always a chance there could be like a 300-car pileup, and you'll end up taking 3 hours. Or right now, if you were to go to the airport, you'd probably have no traffic at all, so it'd probably only take 20 minutes. But these are really improbable events, so you usually make your decisions around the 25, 35-minute window. You don't give yourself 3 hours to get to the airport in case there is an unprecedented car wreck. Of course, as I said, like you do experience tail events, and you want to think about, does this distribution look normal? Are these events tail events? And I think generally the best way to deal with tail events is insurance, because especially if those events are sort of idiosyncratic to you, it's a lot more efficient to sort of give an insurance company the ability to hedge across or diversify across all different people, rather than to keep enough cash on hand to manage that risk.
Neil from our New York City chapter also asks, from a regulatory perspective, what are the levers you would like to be put in place to incentivize businesses to be more resilient down the road?
That's a good question. As I said, like I don't agree that businesses should have months of cash on hand to handle like a government shutdown that lasts 3 or 4 months. I think that's unreasonable, but I do think we should think more about the incentives in place in a lower interest rate environment to be carrying a lot of debt on your balance sheet, and as I said, to have a lot of leverage. I'm not I'm not one of these people who are against share buybacks. I think it's just a different way of returning capital to your investors. But when you do have very low rates and you do have a tax structure in place that favors debt over equity, then you do provide incentives to take on a lot of leverage and to then, buy stocks. And I think that made companies, certainly a lot of companies, a lot less resilient. So I'm not about, I think the low interest rates were not entirely the Fed's fault. I think there were a lot of reasons interest rates are lower, particularly longer term interest rates that are independent of monetary policy. So to some degree, that's not something that regulation can take care of, but we certainly can think more about, as I said, different incentives to be holding debt over equity.
A question from Joel Fulford from our Rice University chapter. Joel's interested in your thoughts on the apparent supply chain risk that has been exposed. Mm-hmm. Do you think that risk is something that should really be mitigated with policy steps, or do you think that it's overstated?
I don't know if it's the role of policy to mitigate it. I honestly am not certain about sort of various tax incentives to move supply chains overseas. If those are in place, then maybe that does make sense. The thing I think about with the future of globalization, and particularly, as I said, having sort of elements of our supply chain go overseas, which essentially we don't make anything entirely here anymore, is in some ways I think of as an economist is that being quite efficient, right? In some ways we've diversified our supply chain across different markets and different skill sets. And that actually means, again, if you're in that middle of the curve, more growth. It's diversification. And it's a big reason why we've gotten a lot of stuff really cheap the last couple decades. But I think we're also seeing that this has also exposed everyone, especially a lot of businesses, to extreme tail risk. So that was the trade-off: more diversification, which means we got more for less, but at the trade-off of a very high tail risk, which again, I was saying is often this trade-off you have in risk management is sort of less risk in sort of more typical places in exchange for being exposed to huge tail risks you never even saw coming. So if in the future going forward, we're making more stuff domestically, I think we're definitely going to see higher prices. We definitely might end up with lower growth, but we'll also be less vulnerable in the tails in case something like this happens again. And I think people have to go into this very aware of what those trade-offs are.
Patrick Savage from our University of Pittsburgh chapter asks, with the rise of social impact bonds from the World Bank, do you believe that that these are an appropriate risk mitigation, risk management tool?
What are social impact bonds?
They're a World Bank product. Are you familiar with them?
No.
Then perhaps a question from Greg Mencken.
Sure, thank you, Allison. And this will be the last question. So thank you, Allison, so much for joining us today. Just to wrap up here, maybe a big question on everyone's mind is, once we get back to normal, once we get to a period where we can start spending our money again, what does that time frame look like to you in terms of an economic recovery? How do you see it comparing to other economic shocks from the last 10 years and beyond? Maybe you can share your predictive thoughts with us.
I don't think anyone knows anything yet. I don't think the data is really there. But again, because the data is not there, we keep talking about V-shaped, U-shaped, W-shaped recoveries. I just don't think whatever's happened before tells us anything about what's going to happen in the future. Just because this is a recession like I've never studied, which is the government actually shut down production for months. This isn't demand driven. This isn't, a crisis of confidence. So I think it's really hard to know. I think the sooner we get back to work, assuming people feel safe and secure and the public health concern has been alleviated, the faster it will be. The longer this drags out, the more damage that will be. And as I said, the more severe recession we'll have.
Allison, thank you so much for joining us today. We really appreciate your thoughts. Thank you to all of our members who logged on today as well. Tune in next week, Wednesday, April 15th. Please note, Wednesday is a new day of the week for our series here. So it's next week, Wednesday, April 15th at 1 p.m. Eastern Time. We will hear from MIT Professor Simon Johnson on tailoring policy and targeting innovation in the post-coronavirus world. Check out our full upcoming lineup at the website you see on your screen. And also, I just want to note that while we did have to cancel the national meeting this year, we haven't forgotten about the awards for Best Student and Best Professional Chapter. Everyone put in a lot of work and made a great effort, and we want to make sure that's recognized. So please check out our newsletter online next week, next Wednesday, when we will be announcing the finalists for that award. It'll be very exciting. So please stay tuned for that. And otherwise, please have a great day. And thanks everyone for joining us, and continued health and well-being to everybody. Thank you.